attitude that was embodied by Andrew Mellon, the Treasury Secretary, and Cal Coolidge, who believed that it wasn't the government's job to interfere with the economy. And we would have frequent panic during which, banks would fail and people would go bankrupt, and, but the markets would eventually clear and people would get back to work and start growing again. And what that did was it kept a level of fear alive on the part of lenders and borrowers of debt. And once these guys got in there and started trying to prevent the markets from clearing, starting with Hoover. Hoover started all this stuff. He was much maligned. He just ran out of time, poor guy. Roosevelt came in and just continued doing everything that Hoover was. So you continue to have the government come in and preventing the markets from clearing. And as a result, borrowers and lenders became increasingly confident that they would never take a loss. That on the borrower's side, the asset that they were buying on credit would always go up in price, and the lenders, same thing, feeling that, well, if they had to foreclose, they'd still make money, right? So there was no risk. And, of course, at the end, it always reaches ridiculous levels where you have the famous example of the strawberry picker in California with no assets was able to buy a $750,000 house with no money down. And who knows what the real value of that house was. I had a particular situation here where I sold an apartment that was owned by my parents for $599,000 at the top of the market. It never had another uptick. And now I come to find out the guy who bought it has a $688,000 mortgage. So, that's a case of not only stupidity, but obviously fraud. So, this is how you get where you get to go from 120% debt to GDP to 360 and probably rising, because the equity is going down and the debt is still there because the markets aren't clearing to a large degree. At least down here, from what I can see in our building, the banks are not foreclosing. They don't want to foreclose because they don't want to start paying the taxes and utilities. They don't want to take the hit to their balance sheet. So at least if they pretend that the thing is still on the books and they don't have to write it off, I think that's one of the motivations. So what do you do after you've had, going back to the 30s, so let's say you've had 75, 80 years of government manipulation and artificial keeping the credit bubble inflated. Who is going to want to let the bubble deflate? Who's going to be the guy that's going to let, and the consequences are frightening. This is a highly leveraged economy, domestic and foreign. Particularly here, of course, but a lot of foreigners own our debt. So they just they're not going to let it happen. They're going to inflate it away. And the government owes a lot of money. They have a vested interest also in reflating, because if you have deflation and you owe that money, how do you pay it back?
Right. In March of 2003, you said the following: depressions are a normal occurrence. It's just been so long since we had one that everybody who remembers is dead.
That's right.
But they are natural phenomena that occur after several generations of uninterrupted prosperity, end quote.
That's right.
And you said you were long gold and gold stocks, and gold has almost tripled. And you mentioned Newmont, which is up over 100% since then, Gold Core up over 300%. We'll get to gold in a minute. But I want to ask you about the first part of your comments. Are we in a depression right now in the United States? And people just haven't recognized it yet. Like when the stock market bounced in 1930 and Hoover said the depression had ended, but in reality it was just about to really devastate America?
It's a depression. I think he described it. I don't know if you saw that. He described it as the not so great depression.
Oh,
it's a depression, all right. But I don't think it's going to be like the 30s, because there's even more. In the 30s they tried to interfere, and they did, but they didn't. They didn't have the tools. There wasn't the communication system. Ben Bernanke came out in November 2002 and said what he would do if deflation threatened to take hold, and he's doing it. And he's actually done just about everything except drop money from helicopters. But all of these policy options that he mentioned in that speech, if you've read it, which seemed outrageous, unthinkable at the time, have actually been done. So they were prepared, and they're doing it.
Moving on to gold and silver, talk to me about where you see gold and silver shares headed, Michael, because you made the comment in 2000 that gold was last at parity with the Dow in 1980 at 850, and you could see that happening in the future again at $6,000 gold and 6,000 Dow. Is that what you still see?
It could happen. In fact, I would say it's more likely than not. I said back then, a ratio of 10 to 1 is a chip shot, and we went through that. Right now, just about 10 to 1. So, I think next stop is like 5 to 1. Now, what that means in terms of the Dow, my guess is that the Dow has come close to probably its low. If you look at a long-term chart, the Dow has tended to go back on an inflation-adjusted basis to the similar level to previous, what used to be the top in terms of ratio to CPI. That would imply that the Dow should go to something like 3 times CPI. We almost got there in March. 3 times CPI right now, I think, would be like 640 something. We got to 666 intraday. So my guess is that will probably be the lower end of the range, for this 20-year period, which will probably be, let's say, 1997 to 2017 or something like that. So let's say we get down to there again, or you could say 7,000, 14,000 might be the range, in nominal terms. By the way, we did not make a new high. When we hit 14,000, we were well below almost 12,000 that we hit in January of 2000 on an inflation-adjusted basis. So let's say you have a high of 14,000 and a low of 7-ish. Yeah, so I would say a reasonable target. That's my next target would be 1,400, and then silver. A reasonable ratio of gold to silver is 50 to 1, so that would imply $28 silver. So silver is really attractive here, in my view, and I have a lot more betting. I have a lot more of my money in silver than gold. The mining stocks are somewhat cheap too, to both silver and gold. So, I really don't own any gold per se. I'm short gold actually against silver and palladium, both of which done well against gold since I put the trades on. And platinum is somewhat cheap to gold, too. So gold is really, it's cheap to paper and not really that cheap to paper because the long-term average is like 10 to 1, which is where we are now. So I'm really more interested in platinum, palladium, and silver.
From the Miami Herald, March 5th of 2000, the guy who taught a lot of investors how to find good stocks doesn't own any now. Michael OHiggins is completely into Treasury bonds. All of OHiggins' signs point to the exit door right now. Prices are so high, he says, it's a mania rather than a market. Too much upside will be followed by a strong downside.
That was March of 2001.
Yeah, that he expects an across-the-board drop of 40 to 50%. And that's the end quote on that. But that was right at the highs.
Yeah.
And the market dropped as you described.
Yeah.
And I know you were a student of that from 1973, 74, which is where you're talking about your education on history comes in, not only living through it, but then looking at the past. So I guess so I understand this, Michael. You were completely out of stocks when that collapse happened, and your fund returned 71% in 2000 when many investors were badly mauled?
Correct.
What about on this recent decline? Were you caught in that?
I got killed.
Okay.
The reason was that the only place to hide was either to be in credit default swaps or in treasuries, And I'm a guy that buys stuff that's undervalued, So once treasuries got below 5%, which I predicted, if you read my articles and interviews back from the early 80s, when we had double-digit long rates, I predicted below 5%.
Yes,
bonds.
correct.
People thought they wanted to lock me up then too. So treasuries weren't cheap. Plus, in